Imagine you are an intensive care unit doctor for just a moment.
Okay.
You've got a patient in critical condition.
Yeah.
And to get a real-time, highly accurate reading on how their heart is performing, you traditionally have to insert this large, rigid needle directly into their radial artery.
Right, an arterial line.
Exactly. And it is dangerous. It's incredibly painful for the patient. It takes precious time. And it introduces this massive risk of severe hospital-acquired infections.
Yeah, it's a huge liability.
But now, what if you could get that exact same stream of hemodynamic data just by slipping a high-tech soft cuff onto that patient's index finger?
I mean, it sounds like science fiction.
It really does. But today, we're looking at a company that is actually turning that exact concept into a multi-billion-dollar commercial reality.
Yeah, and they're doing it at scale.
But ironically, if you just glance at the Wall Street headlines this morning, the algorithmic trading bots seem to think this company is somehow losing its edge.
Yeah, it is the absolute definition of, diagnostic muddy waters for an investor trying to make sense of the financial ticker tape right now.
Definitely.
Because the market often struggles to separate a temporary optical illusion from a structural, fundamental shift in how a business actually operates.
Which is the entire reason we are sitting here today. Welcome to this Talk Ticker's deep dive into Becton Dickinson, or, as you might know them by their stock ticker, BDX.
A fascinating company to unpack.
Truly. We are taking a magnifying glass to their Q3 2026 earnings call. So whether you already hold this stock in your retirement portfolio or you just have it sitting on a watch list wondering if the recent dip is like a buying opportunity, our mission today is very specific.
We want to cut straight through the noise.
Exactly. We're going to bypass the dense corporate jargon, skip the C-suite public relations spin, and deliver the hard numbers and the actionable takeaways you actually need. We want to really understand the machinery operating under the hood of this medical technology giant.
And I would argue there is honestly no better quarter to analyze than this specific one.
Well, for sure.
Because if you only read the headline numbers on a stock screener and just move on, you're going to draw the exact wrong conclusion about the health of this enterprise.
So let's put those headline numbers on the table immediately so you, the listener, have the foundation. On the top line, meaning total revenue generated before any expenses are taken out, Becton Dickinson hit $5 billion for the quarter.
Which is massive.
It is. That's a solid beat of expectations, up 4.4% on an FX neutral basis. But let me pause myself right there because we promised to kill the jargon.
Yeah, we got to explain FX neutral.
Right. So when a company says FX neutral, they are talking about foreign exchange rates. Becton Dickinson sells medical equipment all over the world.
Everywhere.
So if they sell $1 million worth of syringes in Europe, they get paid in euros. But they have to report their earnings in US dollars.
Right, on the spreadsheet.
Exactly. If the US dollar happens to be really strong that quarter, those euros translate into fewer dollars on paper, making it look like sales dropped when they actually didn't.
Which is super misleading.
So FX neutral strips out that currency math and tells us how many physical products actually moved off the shelves.
And stripping out that currency noise is vital for a multinational company of this size. I mean, growing your core volume by 4.4% in a mature medical technology market is huge.
Especially considering the chaotic macroeconomic environment hospitals are currently navigating, right?
Absolutely. It's a signal of robust underlying demand. It literally means hospital purchasing managers are actively choosing to allocate their tightened budgets toward these specific BD products.
Right. And then we move down the income statement to the bottom line. This is the adjusted earnings per share, or EPS.
The profit.
Yeah, which tells us how much actual profit they generated for every single share of stock that exists. They came in at $3.23 per share. That's up 4.9% compared to the same quarter last year, and it handily beat what the Wall Street analysts had modeled. So they're bringing in more cash, they beat the revenue estimates, they beat the profit estimates.
I mean, a top line beat and a bottom line beat, that usually triggers a massive rally in the share price.
But it didn't. Which brings us to the glaring sore thumb that jumps right off the earnings print.
The margins.
Yeah. Their adjusted operating margin was 24.9%. That is actually down 130 basis points from the prior year. Their gross margin was also down 100 basis points, sitting at 54.3%.
Which spooks people.
Definitely. But before you jump in, let's clarify basis points for our listeners who might not, trade bonds all day.
Good call.
1 basis point is simply 1/100th of a single percent. So when we say margins are down 130 basis points, we just mean their profit margin shrank by 1.3%.
Right. But on $5 billion of revenue, that 1.3% is tens of millions of dollars in missing profit.
Exactly. Yeah. And that missing profit is exactly what triggers the algorithmic sell-offs and the bearish headlines.
Yep. The bots just see the drop and hit sell.
So I have to challenge you on this right out of the gate. Help me piece this puzzle together. How does a $5 billion medical behemoth manage to sell more products, make more total money, but somehow their actual profit margins, the percentage of every dollar they keep, is shrinking?
It sounds contradictory.
Or are they suddenly terrible at manufacturing? Should the people holding this stock be reaching for the panic button right now?
Well, to understand why that math looks broken, you have to realize that you are not looking at the same company you were looking at last year.
What do you mean?
You have to understand the era of the business we're analyzing today. This earnings call wasn't just another sequential quarter. This was the company's very first full quarter, operating as what their chief executive officer, Tom Pollan, calls the new BD.
Oh, right. The new BD. I remember this making waves in the financial press a while back. They spun off their massive life sciences business.
They did. For decades, Becton Dickinson operated as this sprawling, highly diversified healthcare conglomerate. I mean, they had their hands in absolutely everything.
Like what?
Basic hospital supplies, complex life sciences, heavy laboratory diagnostics, chemical analysis, you name it.
A bit of everything.
Yeah, but conglomerates often suffer from what Wall Street calls a conglomerate discount. Because they are so large and unwieldy, they rarely operate with peak efficiency.
So their stock price lags behind leaner, more focused competitors.
Exactly. So management executed a massive multi-year strategic pivot. They took that entire life sciences segment, spun it off, combined it with a company called Waters, and entirely removed it from their ongoing business model.
Wow, so that fundamentally changes the identity of the stock.
Absolutely.
We are no longer looking at a sprawling healthcare mutual fund. We're looking at a pure play, highly targeted med tech company.
And when you execute a corporate restructuring of that magnitude, the financial statements always get messy before they get clean.
That makes sense.
Think about it mechanically. When you chop a massive division off a company, you are left with what accountants call stranded costs.
Like overhead that doesn't disappear.
Precisely. You still have the same massive corporate headquarters, the same expensive enterprise software licenses, the same human resources departments, but you have less total revenue to spread those fixed costs across.
I see.
Furthermore, when you shrink the total size of the pie, the performance of the remaining pieces becomes magnified.
So the winners and the losers inside the portfolio suddenly have nowhere to hide.
None at all.
If a specific product line is struggling, it used to get buried under the sheer avalanche of life sciences revenue. Now it sticks out.
Which brings us to the core thesis of this quarter. You have to separate the portfolio into two buckets. You have the 90% of the new company that is absolutely humming, and you have the 10% that is acting like an anchor weight.
Okay, let's dive deep into that 90% first. We need to look at the actual machinery of how they are making money, because this isn't just about selling more plastic tubes.
Not at all.
There's a thematic narrative running through their most successful segments. And it really centers on this aggressive evolution of patient care-like, moving complex treatments out of the hospital and making them more efficient.
Yeah, and the sheer scale of success in their core business is staggering. Over 90% of this new focused portfolio delivered high single-digit growth.
Which is pretty rare, right?
If you study the medtech sector, you know that a mature legacy company consistently hitting high single-digit growth across 90% of its product base is exceptionally rare.
And some of these segments blew past high single digits. Management highlighted 4 specific strategic pillars that delivered double-digit growth.
Those are the heavy hitters.
Let's unpack the mechanics of these, starting with arguably the most culturally relevant topic in healthcare today: biologic drug delivery.
Oh, yeah.
The growth here is heavily driven by the absolute explosion of GLP-1 weight loss drugs.
The GLP-1 phenomenon is fundamentally reshaping global pharmaceuticals. Drugs like Wegovy, Ozempic, and Zepbound are generating billions for the pharma giants that patented them.
Everywhere you look, someone is talking about them.
But retail investors notoriously develop tunnel vision. They all rush to buy the pharmaceutical stocks, completely overlooking the physical infrastructure required to make those drugs work.
The delivery mechanism.
Right. Becton Dickinson is the primary manufacturer of the high-tech syringes and delivery pens required to physically inject those blockbuster drugs into a patient's subcutaneous tissue.
It's the oldest, most reliable strategy in the financial playbook, honestly. During the gold rush, you don't go out and mine for gold. You sit by the river and sell the pickaxes.
Exactly.
And BD is selling millions of very sophisticated pickaxes.
They announced they now have approximately 100 customer agreements signed across novel and biosimilar GLP-1 therapies.
100 agreements. That proves they are the foundational infrastructure for the entire biologics industry, not just a lucky vendor for one specific drug.
Which is a huge distinction. And we need to explain why this matters, because listeners might be picturing a standard 10-cent plastic syringe with a needle on the end. That is not what this is. Biologics, by their very chemical nature, are large molecule drugs.
Let me stop you there, because the chemistry translates directly to the economics here. What does a large molecule actually mean for the physical device?
A large molecule means the liquid is highly viscous. It's thick, like syrup.
Oh, wow.
So if you hand a patient a standard manual syringe filled with a highly viscous biologic, they would have to push down on the plunger with an immense amount of thumb pressure.
Which would be awful.
Right. It causes shaking, pain, and improper dosage delivery. You don't want patients messing up a $1,000 dose.
No, definitely not.
To solve this, Becton Dickinson engineered delivery devices like the Vistra pen. It uses a specialized internal mechanical spring and a damping system to automatically deliver a consistent, powerful, but completely pain-free injection over several seconds.
So they aren't just selling plastic, they are selling a proprietary mechanical engine.
Precise.
And the CEO explicitly noted that a highly engineered device like the Vistra pen captures a significantly higher value for BD than selling a basic syringe. They get to charge a massive premium for it.
And that premium comes with an ironclad economic moat.
How so?
Well, once a pharmaceutical company designs their multi-billion-dollar drug around the specific flow rate, spring tension, and needle gauge of a BD Vistra pen, they lock it in with the FDA.
Ah, the regulatory hurdle.
Yeah. They cannot simply swap to a cheaper generic Chinese syringe next year to save pennies, because they would have to run entirely new clinical trials to prove the new delivery device is safe.
Which takes years and millions of dollars. So the switching costs are astronomically high.
Unimaginably high.
That perfectly explains why they highlighted a brand new collaboration with EMS, which is one of the largest pharmaceutical companies in Brazil. They're launching a semaglutide therapy using the Vistra pen specifically for the Brazilian market.
That's brilliant.
They are embedding themselves into emerging markets before local competitors can even establish a foothold.
So that double-digit growth in biologics is not some temporary spike. It is highly sustainable, high-margin, recurring revenue that's completely locked in by regulatory moats.
Incredible. Let's move to the second double-digit winner, which ties back to the exact scenario I brought up at the very beginning of the deep dive. Advanced patient monitoring, or APM.
Yes.
The growth here is explosive, and it centers on this piece of technology called the Acumen IQ Plus finger cuff.
This is a perfect example of how technology is fundamentally altering hospital economics. Hospitals currently operate on razor-thin margins.
Especially post-pandemic.
Right. They are desperate to shift patient care to lower-cost settings, like moving people out of the intensive care unit and into standard recovery wards as quickly as possible.
Because ICU beds are insanely expensive to maintain.
Exactly. But to do that safely, they need to monitor those patients with extreme precision to prevent sudden complications.
And traditionally, to get that high-fidelity hemodynamic data, which is the detailed measurement of how blood is flowing, the pressure in the vessels, the cardiac output, you had to use highly invasive method.
Very invasive.
As I mentioned in the intro, that means an arterial line. A doctor has to physically thread a catheter into a major artery. It requires highly specialized staff, it takes time, and honestly, every minute that line sits in the patient's arm, the risk of a blood infection skyrockets.
By contrast, the Acumen IQ system provides that exact same caliber of data completely non-invasively, and the mechanics of how it works are just fascinating.
Break it down for us.
So it doesn't just squeeze your finger like a standard blood pressure cuff at the pharmacy. It uses tiny inflatable bladders and photoplethysmography, which are these advanced light sensors, to measure the microscopic changes in blood volume in the fingertip hundreds of times a second.
Okay, but a pulse in your finger isn't exactly the same as the pressure inside your central arteries, right? So how does it actually bridge that gap?
This is where the artificial intelligence comes in. Becton Dickinson trained machine learning models on millions of hours of actual arterial line data.
Oh, that's wild.
Yeah. The software takes the volume waveform from the fingertip and uses those AI algorithms to instantly infer the core arterial pressure waveform. It basically translates peripheral data into central data with astonishing accuracy.
So you take a procedure that used to require a surgeon and a sterile field, and you turn it into a cuff that a floor nurse can slip onto a patient's finger in 10 seconds.
Yes.
It reduces hospital costs, it eliminates the infection risk, and it frees up the ICU beds. It is honestly no wonder this division has seen double-digit growth in both the United States and Europe.
And that leads perfectly into their third double-digit winner, which follows the exact same philosophy of eliminating hospital-acquired infections through brilliant physical engineering.
The PureWick platform.
Exactly.
I feel like PureWick comes up in almost every single healthcare earnings analysis we do, but the streak they are on is historically unprecedented. 37 consecutive quarters of double-digit growth.
It's hard to even comprehend that level of consistency.
That is over 9 straight years of explosive expansion for a single product platform.
To understand why it sells so well, you have to look at the massive problem it solves. For decades, the standard of care for female patients with urinary incontinence or mobility issues in a hospital was a Foley catheter.
Which, for those who aren't in the medical field, means a tube physically inserted up the urethra and into the bladder, held in place by a small inflated balloon.
It is incredibly uncomfortable, and more importantly, it is the leading cause of CAUTI, which stands for catheter-associated urinary tract infections.
So that are awful.
Yeah, these infections cost hospitals billions of dollars a year in penalties and unreimbursed care, let alone the suffering it causes patients.
Right.
PureWick completely upended this. It is a non-invasive, external alternative.
Explain the physics of it, because it sounds incredibly difficult to manage fluid externally without causing leaks or, skin breakdown.
It relies on a combination of material science and gentle vacuum physics. The device itself is a soft, flexible, ergonomically shaped wick covered in a specialized porous fabric. It is placed entirely externally.
Yeah.
The genius is that it is connected to a low-pressure hospital wall suction system. When the porous fabric detects moisture, the vacuum gently and instantly pulls the fluid away from the skin and into a sealed collection canister.
So it keeps the skin completely dry, preventing ulcers, and entirely eliminates the internal infection risk of a Foley catheter.
Precisely.
But what impressed me this quarter wasn't just the product itself, it was how aggressively BD's commercial team is pushing it into new channels. They highlighted a specific massive push into the Veterans Administration hospital system.
They executed a textbook commercial expansion strategy there.
How so?
They didn't just hope VA doctors would magically start ordering it. At the beginning of the year, they sought specific reimbursement codes within the VA system, and they allocated a dedicated, highly trained sales team specifically to target those military facilities.
And the return on that investment was virtually instantaneous. They reported that the VA channel alone is already generating a run rate of well over $1 million a month in pure incremental revenue.
It's a huge win.
Plus, they tease that they're in the early stages of pursuing insurance reimbursement for at-home use.
That's the holy grail.
Yeah, which would unlock a completely new, massive addressable market of elderly care outside the hospital walls.
You combine the biologics pens, the AI monitoring cuffs, the PureWick system, and their advanced tissue regeneration surgical materials, which also posted double-digit growth, by the way, and you have an incredibly resilient, diversified growth engine.
The core of this company is ruthlessly taking market share.
Without a doubt.
I want to look at one specific leading indicator they shared that proves that market share dominance. In their medical essentials segment, which is their bread and butter business of catheters and IV sets, the CEO pointed out a fascinating internal metric they track.
The needle ratio.
Yeah. He said they monitor the ratio of blood collection needles sold versus the number of collection tubes sold. When I first read that, I scratched my head. Why would a retail investor care about a needle-to-tube ratio?
It seems like such a weird metric until you think about the actual process.
Right.
Think about your last annual physical. You sit in the chair and the phlebotomist inserts a single needle into your arm. But they don't just take one sample.
No, they usually take a few.
Exactly. Depending on how many tests your doctor ordered, they might swap out 3, 4, or 5 different colored vacuum tubes onto the back of that single needle hub.
I see.
Yeah.
So it's one needle per patient, but multiple tubes per patient.
Exactly. Becton Dickinson is the dominant global supplier of both items. And right now, they are seeing a global uptick in tube utilization, severely outpacing needle utilization.
So what does that actually mean?
This means that for every single patient walking through hospital doors, physicians are ordering far more complex, comprehensive diagnostic testing panels than they used to.
That tells us two incredibly bullish things about the macro environment. First, hospital utilization rates are robust. People aren't avoiding the doctor. Patient volumes are strong.
All right.
Second, the acuity of care. The intensity of the investigation is rising. Whether doctors are running deeper cancer screens or more thorough metabolic panels, it requires a higher volume of BD's high-margin proprietary consumables.
It is a brilliant, granular micro indicator that tells a massive macro story. And it was heavily reflected in their specimen management business, which grew a staggering 14% in the U.S. this quarter.
Wow, 14%. But in the spirit of total transparency, management did not claim that 14% is their new normal baseline.
No, they were honest about that.
Yeah, they explicitly admitted that part of that massive spike occurred because their competitors were struggling with severe supply chain back orders. BD was simply able to step in and capture all that orphan demand.
Which is not luck, by the way. It is the direct result of a massive internal initiative called BD Excellence.
I want to spend some time on this because when a CEO starts talking about excellence programs and operational synergy, my eyes usually glaze over.
Yeah, it's usually just buzzwords.
Exactly. It usually sounds like management consultants trying to justify their retainers. But the actual physical numbers they attach to this program are wild.
The BD Excellence program is essentially the deployment of lean manufacturing and Six Sigma principles across every single factory they operate globally.
Okay.
Tom Pollan noted that just a few years ago, the company was executing about 50 Kaizen events a year.
What's a Kaizen event?
A Kaizen is a Japanese business philosophy of continuous improvement. It usually involves shutting down a specific manufacturing line for a few days so the engineers and the floor workers can collaborate to eliminate tiny inefficiencies in how a product is built.
Oh, that's interesting. So 50 a year across a global footprint isn't really that much.
No, but he said this year they are on pace to execute over 2,000 Kaizens.
From 50 to 2,000.
Yes. The cultural shift required to pull that off is immense, and the financial results are undeniable. Through these thousands of micro-optimizations, they are delivering approximately 8% gross productivity improvements in their manufacturing plants.
It's huge.
It means they're making the exact same products 8% faster and cheaper than they were a year ago.
And it creates massive systemic resilience. Their back orders are sitting at record lows, and their customer service levels, which is their metric for fulfilling hospital orders on time and in full, are running above 90%.
That's incredible reliability.
So going back to that blood tube example, when a competitor's factory stumbles and they tell a hospital, sorry, we can't get you blood tubes for a month, BD's supply chain is so highly optimized that they can immediately swoop in, fulfill that hospital's order the next day, and permanently steal the account.
Supply chain superiority is a massive competitive moat in healthcare. Over the last several years, this BD Excellence program has quietly driven well over 500 basis points of margin expansion.
That's the real engine.
It is the hidden engine generating the cash they need to fund all their new R&D.
They are also investing heavily in how they physically sell these optimized products. They created a brand new role, Chief Revenue Officer.
Mike Feld.
Yeah, bringing in Mike Feld right after the life sciences spinoff closed. What exactly did he change?
He fundamentally rewired the commercial nervous system of the company. He changed the compensation structures to properly incentivize the sales force toward the highest margin products. More importantly, he deployed custom artificial intelligence tools directly into the iPads and laptops of the sales reps. The AI analyzes hospital purchasing data to tell the reps exactly which accounts have the highest probability of upgrading their equipment.
So as the CEO phrased it, it tells them where to hunt.
Exactly.
They also back that up with hard cash. They made a highly targeted $35 million incremental investment to physically grow specific sales teams at the beginning of the year.
Real investment.
They increased the headcount of the advanced patient monitoring sales team by 15%. And the peripheral intervention team by 15%.
And the return on investment is immediate and highly measurable. Management stated that just in the first couple of quarters, those newly hired APM sales reps generated enough new contracts to contribute 100 to 150 basis points of the total double-digit growth for that entire segment.
Wow. So it is a highly predictable machine. You put $1 of targeted commercial investment into the top of the funnel, and a highly profitable recurring revenue stream comes out the bottom.
That's the dream setup.
Okay. We have spent half the deep dive establishing that the underlying physical machinery of Becton Dickinson, the 90% of the company driving the future, is operating at a masterclass level.
Absolutely.
The GLP-1 pens, the AI cuffs, the supply chain dominance. So we are forced back to the ultimate question we asked at the very beginning. If all of this is true, why did the profit margins shrink by 130 basis points? Where is the anchor weight?
The anchor weight is isolated in the remaining 10% of the business, and it is a combination of geopolitical, macroeconomics, and honestly, accounting quirks.
Let's look at the margin compression first.
Sure. So the CFO, Vitor Roque, offered a very specific explanation for that. He stated that 110 basis points of that margin drop was purely due to the impact of international tariffs.
Let's break down the mechanics of a tariff hit, because it is crucial for an investor to understand the difference between a broken business and a taxed business.
Exactly. When you see a margin drop, your first question must be, did the company's factories suddenly become inefficient, or did their products lose pricing power against competitors? In this case, the answer is a hard no. A tariff is a geopolitical tax imposed at the border. Becton Dickinson has a massive, complex global supply chain. They might manufacture specific catheter components in Asia, ship them to Mexico for final assembly, and then import them into the United States for sale.
And with the current trade tensions and shifting international trade policies, moving those physical goods across borders suddenly requires paying a massive premium to the government.
It is a friction cost that hits the cost of goods sold instantly. But here is the critical takeaway. If you mathematically strip out that 110 basis point tariff tax, their core operating margins were essentially completely flat year over year.
Oh, wow. Despite all the other noise in the market.
Exactly. The business didn't get less profitable. The cost of global citizenship simply went up.
That dramatically alters the narrative of the shrinking margin. But tariffs explain the margin drop. They don't explain the revenue drag. Management mentioned 3 specific headwinds that dragged down the total revenue growth.
Yeah, the 3 strikes.
Let's start with the largest one, Allirith. This is their smart infusion pump division. The CEO blamed a difficult prior year comparison. I want you to unpack the history here, because this is one of the most misunderstood accounting distortions in medtech right now.
This requires us to look back a few years. Allirith infusion pumps are ubiquitous in modern medicine. When a patient is hooked up to an IV bag delivering precise doses of critical medications, like fentanyl, insulin, or chemotherapy, they aren't just letting gravity do the work.
Right, that would be dangerous.
Very. The fluid runs through a sophisticated digital pump that ensures the exact microdosage is delivered at the right speed.
And because these pumps are delivering lethal medications, the software running them is heavily scrutinized by the Food and Drug Administration.
Precisely. A few years ago, Becton Dickinson discovered software glitches in the Allirith pumps, issues with alarm priorities and key press bouncing that could theoretically lead to improper dosing. Yeah. The FDA stepped in and issued a strict halt on all new shipments until BD could entirely rewrite and validate the software architecture. For years, hospitals could not buy new Allirith pumps,
which created an incredible amount of pent-up demand. Hospitals were nursing along aging, outdated pumps, just waiting for the FDA to give BD the green light.
Think of it like a massive concrete dam holding back a river of purchasing capital.
I love that analogy.
Last year, Becton Dickinson finally received that FDA clearance, and the dam just burst. A massive historic flood of pent-up orders rushed through the system as every hospital in the country simultaneously upgraded their fleets. Becton Dickinson recorded astronomical, record-breaking sales for the Allirith division last year.
But that flood was temporary.
Exactly.
Okay.
Now we are a year later. The flood is over. The river of hospital demand is flowing at its normal, healthy, sustainable pace again.
But when Wall Street analysts look at the spreadsheet today,
they compare this year's healthy river to last year's artificial flood, and they say, wow, sales are down.
It is a complete illusion. The business is fine. The baseline is just heavily distorted. Management explicitly predicted this at the start of the year, noting it would cause a 100 basis point headwind this quarter.
And that is exactly what happened. It is an accounting quirk, not a loss of market share.
The second revenue headwind they cited was vaccines. This one feels a bit more intuitive, but let's cover the mechanics of it just to be sure.
This is simply the post-pandemic hangover. During the height of the COVID-19 pandemic, global governments were mandating billions of doses of vaccines. Becton Dickinson was running their syringe factories at absolute maximum capacity to supply global vaccination campaigns.
They were churning out specialized glass and plastic vials and injection systems at a scale the world had never seen.
But as we return to a normalized endemic environment, that massive surge in demand has naturally cratered. They are comparing current normal syringe sales against pandemic-era hyper sales.
Again, a baseline issue.
Right. However, the CEO gave a very optimistic update here. He mentioned that they built a centralized analytics team specifically to forecast these macro shifts, and the data shows stabilization.
So they expect to start lapping this headwind next quarter. Lapping meaning the comparative baseline finally drops down to normal levels, so the year-over-year drag essentially disappears.
It is a huge sigh of relief for institutional investors. You want those pandemic distortions washed entirely out of the baseline so you can accurately model the future.
Which brings us to the third and final strikeout, dragging down the numbers. China. If you follow any medical device maker right now, you hear about the Chinese market constantly. What is the physical mechanism causing the pain there?
It is a combination of two major factors. First, the Chinese government is executing a massive anti-corruption campaign across their hospital system, which has severely delayed capital equipment purchasing.
Because hospital administrators are terrified to sign large contracts while under investigation.
Exactly. Second, China utilizes a system called volume-based procurement, or VBP. The government essentially forces Western medical device companies to drastically slash their prices in exchange for guaranteed bulk purchasing volumes.
Which destroys profit margins for companies that rely on premium pricing. I was looking at their international exposure, and given those massive pressures in China, I honestly assumed Becton Dickinson would be bleeding heavy cash over there. But the overall numbers don't reflect that level of panic. Why is that?
Because of a crucial mathematical reality that management made sure to emphasize on the call, China now represents only about 4% of the new ED's total global revenue.
4%. That is tiny for a multinational of this scale.
And it goes directly back to the life sciences spinoff we discussed earlier. The old life sciences division had a massive, heavy exposure to the Chinese laboratory market.
Oh, I didn't realize that.
Yeah, by spinning that off, the remaining pure-play medtech business was structurally insulated from the Chinese geopolitical shockwaves.
That is a phenomenal strategic realization. If China is only 4% of your revenue today, and your other global businesses like the GLP-1 pens and the AI cuffs are growing rapidly, that 4% is going to naturally dilute down into the threes next year. It mathematically shrinks itself out of importance.
It ceases to be a systemic risk and becomes a mere rounding error on the balance sheet. So when you look objectively at the 10% of the portfolio that is struggling, Allirith is a temporary accounting illusion, the vaccine hangover is officially bottoming out, and China is shrinking itself into irrelevance.
I think we have successfully debunked the bearish headlines here. This margin miss narrative is quite literally a temporary Halloween mask placed over a fundamentally booming business.
The underlying core is incredibly robust, which makes their forward-looking guidance so interesting to dissect.
Let's transition into how management is viewing the future, because this is where a lot of retail investors get tripped up by the corporate phrasing.
It gets very nuanced.
Let's look at the guidance. For the current fiscal year, which is FY26, management is essentially taking a victory lap. Based on the strength of this third quarter, they're raising the midpoint of their full-year adjusted EPS guidance to a very tight, confident window, $12.62 to $12.72.
And on the top line, they now expect full-year revenue to land at the high end of their previously stated low single-digit target range.
Nice.
This will be aided by about a 100 basis point tailwind from foreign exchange rates, as the currency markets have shifted slightly in their favor.
So FY26 is locked in. The business is strong. They're raising the bar. But I need to issue a massive jargon translation warning for our listeners regarding next year, FY27.
Uh-oh, the FY27 comments.
Yeah. During the Q&A segment of the earnings call, an analyst pressed the CFO, Vitor Roque, for early thoughts on next year. Vitor stated they are currently forecasting low single-digit revenue growth with only modest EPS leverage.
If you are an algorithm scanning headlines or a retail investor reading a quick summary, hearing low single-digit growth and modest leverage sounds terrible.
Sounds awful.
It sounds like a hyper-growth company rapidly running out of steam. It sounds like a massive downgrade.
It sounds like a giant red flag. But I want to ask you to translate this specific Wall Street jargon into the mechanical reality of the business. Why on earth is the CFO guiding so conservatively for a company that we just spent 40 minutes establishing is firing on all cylinders?
It comes back to those accounting math quirks combined with a very deliberate old-school management philosophy of heavily underpromising so you can over-deliver.
Standard sandbagging.
Exactly. Let's look at the low single-digit revenue warning first. This is almost entirely driven by the Allirith pump situation.
The dam bursting analogy.
Exactly. Next year, in FY27, Becton Dickinson faces the absolute peak of that difficult year-over-year comparison. Management explicitly started that lapping the final wave of those massive catch-up pump sales creates an automatic 200 basis point, so a full 2% mathematical headwind on their total corporate revenue next year.
Okay, so let me make sure I have the math right. If the underlying business, the 90% we love, is growing at a very healthy 6 or 7%, that automatic 2% penalty from the Allirith pumps drags the reported headline number down to 4 or 5%.
Yes.
And 4% falls into the low single-digit phrasing bucket.
That is precisely how the math works. It is an optical illusion created by an artificially high baseline, not a sudden deterioration in the hospital demand for their products.
Got it.
And once they finally get through FY27, that 2% anchor drops off entirely, and the reported revenue will suddenly spring back up to match the underlying mid-single-digit reality.
So, to you, the investor listening to this deep dive, when you see headlines in a few months warning about sluggish, low single-digit growth for BDX next year, do not let it spook you out of your position.
Please don't.
It is mostly an accounting hangover from those pump comparisons. It is not a broken business model.
That is the most critical takeaway for long-term holders. But management's conservatism doesn't stop with the Allirith pumps.
Oh, there's more.
Yeah. The CFO's comment about only expecting modest EPS leverage is also heavily sandbagged against macroeconomic risks. Specifically, they are playing defensive regarding global inflation and commodity prices.
Which leads to a really fascinating pivot. It is amazing how quickly a medical technology earnings call can suddenly turn into a discussion about Middle Eastern geopolitics and commodity oil prices.
It has to, because you have to trace the supply chain back to the raw earth. What are millions of syringes, IV tubes, diagnostic collection vials, and catheter components physically made of?
Plastic resins, polyurethane, silicone, polypropylene.
And plastic resins are a direct downstream byproduct of crude petroleum. When barrel prices for global crude oil spike due to geopolitical conflicts or supply cuts, the cost of the raw plastic pellets that BD buys by the ton goes up.
The input costs skyrocket.
Exactly. The CEO noted that these resins and molded plastic components make up about 5% of Becton Dickinson's total cost of goods sold, or COGS.
5% doesn't sound like a massive exposure initially. But when your total cost of goods sold is measured in the billions of dollars, a sudden spike in oil prices can wipe out tens of millions in pure profit.
Precisely. Management quantified this exact risk for the analysts. They stated that if global oil prices were to spike and sustainably stay above $100 a barrel, it would create a direct $60 to $70 million hit to their bottom line next year.
But oil isn't anywhere near $100 a barrel right now. It is trading significantly lower.
It is. But management is deliberately choosing to bake that worst-case $100 a barrel scenario into their modest EPS baseline for next year anyway.
Talk about playing it safe.
They are playing it incredibly safe. They would much rather assume disastrously high input costs, set Wall Street's expectations low, and then surprise the market with a massive upside beat if oil stays cheap.
And they aren't just sitting back crossing their fingers hoping oil stays cheap. Vitor made it very clear that they have aggressive pricing actions already underway.
Because they have the power to do so.
Right. Because they hold such a dominant market share in these critical supplies, they have the pricing power to pass some of those inflationary costs along to the hospitals during contract renewals.
Which is key.
Furthermore, they are relying on that BD Excellence program we discussed. They are finding new procurement savings, eliminating factory waste, and speeding up assembly lines to physically offset the inflation.
It is a textbook masterclass in mature corporate management. You establish a rock-solid, executable commitment, a financial floor that you know you can hit, even if the entire macro environment turns against you.
And then you spend the next 12 months pulling every operational lever you have to crush those expectations.
Exactly.
I just want to summarize this flex because it is staggering. They have a 200 basis point mathematical penalty from the Allirith pumps. They're getting hit by a 110 basis point tariff tax at the border. They are assuming a worst case apocalyptic scenario for global oil prices.
A lot of headwinds.
And despite all of those massive compounding headwinds, they are still projecting top-line growth and earnings per share expansion next year.
It speaks entirely to the structural resilience of the new BD model. The mix of the products they are selling is so highly favorable that it absorbs the hits.
It's a highly defensive portfolio.
Think about the profit margins. Every single time they sell one of those highly engineered GLP-1 biologic pens or install an AI-powered non-invasive patient monitor instead of a basic low-margin legacy supply, they are permanently shifting the overall profitability profile of the entire company upward.
Which brings us to the ultimate proof of corporate health. We could sit here and debate basis points, Kaizen efficiency events, and needle-to-tube utilization ratios all day. But at the end of the day, in the world of finance, cash is the only thing that cannot be manipulated by accounting tricks. Cash is king. Let's look at their cash flow and how they are allocating their capital, because this tells the unvarnished truth about the business.
It is the ultimate lie detector test for an earnings report, and the results here are spectacular. Year-to-date, Becton Dickinson generated $1.7 billion in free cash flow.
Wow.
That is an astonishing 45% increase compared to the exact same period last year.
Let me make sure listeners understand free cash flow. This isn't just revenue. This is the cold, hard cash left in the bank account after they have paid all their employees, paid for all the raw plastics, and paid to maintain and upgrade all their global factories.
It's the real money.
A 45% increase while managing a massive corporate spin-off, absorbing tariff hits, and navigating a chaotic hospital macro environment.
That is incredible.
Where did all that extra cash actually come from?
Vitor Roque attributed it to two main drivers. First, significantly improved working capital management.
Meaning what, exactly, for the non-accountants?
Working capital management is essentially how efficiently a company handles its short-term assets and liabilities. It means BD is getting much better at collecting the cash they are owed by hospitals, faster reducing their accounts receivable.
Getting paid sooner.
Yeah, and it also means they are managing their physical inventory better, not tying up billions of dollars in plastic tubes sitting idle in a warehouse.
They're running a tighter ship. What was the second driver?
Lower non-operating cash items. Specifically, during the height of the FDA issues with the Allirith pumps, BD was bleeding massive amounts of cash-paying armies of regulatory lawyers, software engineers, and remediation consultants.
All those emergency costs.
Right. Now that the pumps are cleared and back on the market, those massive cash outlays are finally falling away, allowing the profit to flow straight to the bottom line.
So they have stopped the bleeding, they are running the factories tighter, and they have this massive $1.7 billion war chest. What exactly are they doing with all this cash?
They are doing exactly what you want a mature company to do. They are returning it directly to you, the shareholder. They operate with a very disciplined, shareholder-friendly capital allocation framework. Year-to-date, they returned a total of $3.1 billion directly to investors.
Let's break that $3.1 billion down because the ratio is important. They spent $2.3 billion on share repurchases and distributed $900 million in standard quarterly dividends.
That ratio is a massive psychological signal. When a management team authorizes $2.3 billion in stock buybacks, literally going into the open market and buying their own shares to retire them, they are sending a very clear, unambiguous message to Wall Street.
They think the stock is cheap.
They are stating that they believe their own stock is fundamentally undervalued relative to the long-term, multi-decade cash generation power of the business.
It is the ultimate put your money where your mouth is maneuver. If the CEO thought the company was actually struggling, they would hoard that cash to weather the storm. Instead, they're aggressively buying their own dip. They also noted on the balance sheet that they ended the quarter with a net leverage ratio of approximately 2.9 times.
Which means their total debt is roughly 2.9 times their annual earnings. And they reiterated their commitment to grinding that leverage ratio down to their long-term conservative target of 2.5 times.
So let's review the financial posture. They are actively paying down debt to deleverage the balance sheet. They are maintaining a very healthy, growing dividend. They are buying back massive amounts of stock to increase the value of your remaining shares.
A triple threat.
And they are still telling analysts that they have the dry powder and financial firepower to invest in high-growth, strategic M&A mergers and acquisitions if they see the right technology startup to acquire. That is the definition of a fortress balance sheet.
It is a position of immense financial strength, completely insulated from the low single-digit revenue panic the algorithmic traders are currently obsessed with.
Okay, we have covered a massive amount of ground here today. We have traced the supply chain from raw petroleum to high-tech biologic injection pens. Let's bring it all together for the outro. The bottom line.
Let's do it.
We promised our listeners an opinionated stance on this stock, and I think the mechanical evidence we've uncovered here is overwhelming.
I agree completely. This was a fundamentally strong, highly bullish quarter that just happens to be wearing a disguise of temporary, highly specific anchor weights.
The ultimate optical illusion.
Exactly. The headline, margin miss, was driven by geopolitical tariffs at the border. The scary future revenue warning is driven by an accounting comparison for a one-time flood of infusion pump sale.
Right.
But if you strip away the noise and look at the actual daily business of Becton Dickinson, the 90% of the portfolio that is driving the future, it is firing beautifully.
So for the person listening to this deep dive right now, who is holding this stock or considering opening a position, what is the actionable takeaway?
From an analytical perspective, this looks like a very strong hold or even an accumulate strategy, particularly on any price dips caused by headline confusion over the next few quarters.
It's a solid long-term play.
Absolutely. The underlying growth engines driving this company, the transition to automated pharmacy dispensing, the massive demographic tailwinds in GLP-1 weight loss biologics, the shift from invasive to non-invasive AI patient monitoring, these are not fads.
No, not at all.
These are structural, multi-decade megatrends in global healthcare. And Becton Dickinson has positioned itself not just to participate in these trends, but to provide the critical, patented physical infrastructure that actually enables them to exist.
They are the toll booth on the highway of modern medicine. Every time a new biologic drug is invented, BD collects a toll for the delivery pen. Every time a hospital tries to cut costs in the ICU, BD collects a toll for the AI monitoring software.
And they are a very well-run toll booth that is actively expanding its profit margins through ruthless operational efficiency on the factory floor and throwing off billions of dollars in free cash flow to reward their investors.
I love that framing. But before we wrap up today, I want to leave you, our listener, with one final provocative thought to mull over or research on your own.
Lay it on them.
We spent a lot of time talking about how they are generating all this cash and how they are navigating these chaotic supply chain hurdles like tariffs and oil prices. But Tom Pollan dropped one tiny, almost throwaway breadcrumb near the very end of his prepared remarks that I think could be the most important narrative for this stock as we approach the end of the decade in 2030.
The AI supply chain initiative.
Yes. He briefly mentioned that they have begun investing heavily in the deployment of a standardized digital platform designed to run artificial intelligence across Becton Dickinson's entire end-to-end global supply chain.
We talked earlier about the BD Excellence program. The 2,000 Kaizen events driving 8% productivity gains. That is the physical optimization of the business. Engineers tweaking machines on the factory floor.
But this new AI initiative is about the digital optimization of the enterprise.
That's a whole new level.
Think about the sheer scale of the math required to run BD. They are managing billions of individual plastic components across dozens of countries. They are tracking global crude oil prices for resin procurement. They are dealing with shifting geopolitical tariffs.
It's massively complex.
And simultaneously, they are trying to predict exactly how many specific blood collection tubes a mid-sized hospital in Ohio is going to need on a random Tuesday next month. If they can successfully deploy a machine learning model that perfectly predicts those hospital inventory needs, dynamically routes international shipments to avoid the worst tariff borders, and perfectly times raw material purchases to counteract global oil swings,
the margin expansion could be absolutely explosive.
Right.
If you think their current 25% operating margins are impressive, a fully AI-optimized, frictionless global medtech supply chain could see a massive, unexpected rebound in profitability by the end of the decade.
It changes everything.
They wouldn't just be reacting to the macro environment, they would be algorithmically insulating themselves from it.
It is the ultimate cure for the margin optical illusion we spent this entire deep dive discussing. You cross your eyes, you look past the temporary headwinds of the new BD transition, and what you see is a fundamentally transformed company quietly building the most resilient, high-margin machine in the healthcare sector.
The transition was messy, but the new BD is really just getting started.
And we will be right here to track every metric along the way. Thank you for joining us on this Talk Tickers deep dive. Keep your eyes on the underlying mechanics. Do not let the Wall Street headlines fool you, and we will catch you on the next one.